This voice is taken from an article with the title, "What Role Do Currency Pegs and Bands Play in Influencing Exchange Rates?" which has been published on TraderTalks.net. Currency pegs and bands are important tools used by governments and central banks to influence exchange rates in the foreign exchange market. A currency peg is a fixed exchange rate between two currencies, which is deliberately set and maintained by a government or central bank. This is usually done to stabilize exchange rates and to keep their currency value relatively stable with respect to other currencies. Currency bands are a range of exchange rates that the central bank allows the exchange rate to fluctuate within. The central bank is usually responsible for maintaining the exchange rate within the given band. Currency pegs and bands provide stability and predictability in the foreign exchange market. Governments and central banks use these tools to influence the exchange rate of their currency in order to promote economic growth and protect their domestic industries. By maintaining a fixed exchange rate, governments and central banks are able to protect their domestic industries from the volatility of the foreign exchange market. This helps to keep domestic prices stable and allows domestic businesses to remain competitive in the global marketplace. In addition, currency pegs and bands can be used to influence exchange rates in order to promote economic growth. By setting and maintaining a fixed exchange rate, governments and central banks are able to encourage foreign investment in their domestic economy. Foreign investors are more likely to invest in an economy with a stable currency. This in turn encourages domestic businesses to expand and create jobs, which helps to stimulate economic growth. Finally, currency pegs and bands can be used to control inflation. By setting and maintaining a fixed exchange rate, governments and central banks are able to keep the domestic currency from appreciating too quickly. This helps to keep the prices of goods and services stable and prevents the domestic currency from becoming overvalued. In summary, currency pegs and bands play an important role in influencing exchange rates in the foreign exchange market. They provide stability and predictability, encourage foreign investment, and help to control inflation. These tools are used by governments and central banks to promote economic growth and protect their domestic industries.